This is The Gist, the essential podcast for the discerning listener.
Welcome to The Gist. I'm John.
And I'm Mary. It is Friday, August the 21st, 2026. Let's get right into the gist view. Today is all about the brick wall of reality.
Exactly. You can spin a great story. You can build a political narrative, but eventually you have to face the market.
We are seeing this play out in two very different ways today. First, with an e-commerce company built on politics, and second, with the United States Treasury.
In both cases, the core insight is the same. Follow the money. Who really benefits when a business or a government tries to override basic market fundamentals?
Spoiler alert, it is usually insiders and traders. Regular folks are left holding the bag.
Let's start with PublicSquare. It launched back in 2023. The pitch was an anti-woke alternative to Amazon.
The idea made sense to some, build a parallel economy for conservative shoppers. But the reality? The stock just plunged 99%.
It is now facing delisting from the NYSE, that is the New York Stock Exchange, the largest stock exchange in the world by market cap.
They are officially out of cash. The company laid off 41% of its staff. They dismantled their core marketplace. Now they are pivoting to financial technology.
According to Forbes, they have lost nearly $160 million since launching. But let's apply our power analysis here. Who actually made money on this?
Political insiders. The Wall Street Journal reports that Donald Trump Jr. collected over $500,000 in consulting fees this year.
Meanwhile, the company lost over $57 million last year. His payout was bigger than the CEO's $300,000 salary. And he barely attended 60% of the board meetings.
So the platform acts as a rent extraction vehicle. Influencers promote the company. They collect risk-free advisory payouts. And retail shareholders, the everyday investors, absorb all the massive failures. Political grievance simply does not equal a competitive business.
Speaking of narratives failing the market test, let's look at the United States Treasury.
Treasury Secretary Scott Bessent tried to play defense this week. Market concerns over massive United States fiscal debt are pushing interest rates up.
To fight this, Bessent doubled bond buybacks. He threw at least $4 billion at long-term bonds to force yields down.
A quick definition here, bond yields are the return an investor gets. When the government buys its own bonds, demand goes up and yields go down.
But the move only worked for one single day. 30-year yields instantly surged back up to 5.25%.
Bond traders simply rejected the intervention. They saw right through it.
Right. A $4 billion Band-Aid cannot hide a $32 trillion debt burden.
Just like PublicSquare, state financial engineering cannot override basic math. Consumers and bond traders always punish uncompetitive realities.
Turning to Europe and global finance, Chinese retail investors are accidentally weaponizing Beijing's policies.
This comes from a new study by the CEPR, that is the Centre for Economic Policy Research, a major network of European academic economists.
Here is what is happening. When Beijing tightens its money supply, Chinese citizens look for a safe harbour.
They use a program called QDII. It stands for the Qualified Domestic Institutional Investor Scheme.
Basically, it's a legal pathway that lets regular Chinese citizens access foreign financial markets.
Think of it like a safety valve. People are bypassing domestic economic trouble by moving their cash abroad.
But as they scramble to rebalance these foreign portfolios, they actually depress the returns of the international stocks they touch.
It is not the Chinese state dumping stocks. It is thousands of everyday households voting with their wallets.
The overall size of this capital flight is still small compared to global markets, but it shows a massive structural shift in how money flows across borders.
Finally, let's look at Germany's energy security. The outlook is not great.
German natural gas storage is sitting at roughly 50% capacity right now in late August.
The broadcaster ZDF reports that is 26 percentage points below the average for recent years.
The Bundesnetzagentur, that is Germany's federal regulatory authority for energy and networks, is raising the alarm.
They warn that this missing gas removes the country's buffer. If winter brings unexpected events, they are heavily exposed.
Especially if there are any disruptions to LNG or liquefied natural gas terminals.
So who absorbs the risk here? Industrial consumers, the big factories.
Exactly. If supplies get tight, industrial players will be the first to face the squeeze. Resource flows dictate economic survival.
That is the big picture for today. Let's check the temperature.
Today's global temperature is freezing cold for political market narratives, boiling hot for bond yields, and looking pretty chilly for German factories bracing for winter.
Reality bites. Thanks for joining us on The Gist.
If you found today's breakdown useful, you should definitely grab The Gist in your inbox every day. It is completely free.
Just tap the subscribe link right there in the show notes, and we'll see you on Monday.
The Gist, News Digest, and podcast are entirely written and produced by artificial intelligence. The Gist is out 3 times a day, every day, providing you with a liberal perspective on what to expect next. For more information and donations, visit thegist.online. Thank you for listening.